Kelsey is with us in Baltimore, Maryland. Kelsey, how can George Camel and I help?
Hi, guys. I'm so excited to be talking to you.
You too.
So I have a question about whole life insurance. My parents got a policy for me when I was in the crib and passed this policy on to me a few years ago.
Mm-hmm.
We took a loan out from it to put down on the house, and just kind of knowing we never had to pay it back, and just knowing that I didn't really care about this policy. It's very small. We have other life insurance that's not whole. I'm not sure what to do on, to keep it active. I pay about $800, $900 a year.
Cancel it.
And really?
Cancel it.
What about the tax implications?
There
Should I
aren't
worry
any.
about that at all?
There aren't any.
Oh.
Here's why.
Okay.
Your tax basis in a whole life policy is the total of the premiums paid in. There is no possible way that you took out of this policy more than your parents has paid in.
Yeah.
They're just horrible. It's a black hole for money, especially kid whole life policies. Your parents meant well. They were really sweet, and the net result was they were able to help you with the down payment on a house. Had they actually invested in a mutual fund with the same amount of money they put in this policy, they could have just bought you a house, but that's a side issue. That's over. That's water under the bridge now. So that's how bad these things are mathematically. So, but anyway, you don't keep it around. No, it's not a pet, and we can honor their intent and their heart without, continuing to throw money off the bridge every day, every month, every year.
Right.
So, I would just
Okay.
if you don't need the life insurance, I just cancel it.
Nope.
If the basis does come in, and they will send it to you because they'll threaten you with this, it's their way of getting you to not cancel it. Apparently, that's already happened. That's where you got this information. The agent says, "Oh no, you're going to get taxed," and you're like, "Yeah, it's $4, but instead of $800 this year." So I'm going to give you a 95% probability that there's no taxes on it at all. On the 5% chance that there is, your taxes will be less than your premium this year.
Okay.
So I mean, at the end of the day, when you get it all done, it's not going to, because your basis is the total of the premiums paid in. And only if you receive more than that, including the loaned amount, because the loan is paid off as a part of the cancellation. And if there's anything above the loan that comes to you, those two things, if that is larger than the total of the premiums, only then will there be taxes. And it almost never is, because these things really suck so bad.
Right. Okay, great. Thank you so much, Dave.
Thank you for the call. Appreciate you joining us. So that is like a product from the 1940s and 1950s. It's like an alligator. It's a dinosaur that has survived into the modern era.
How do they do that? Slick marketing?
It's a dinosaur because when you sell it, people buy it. Mm-hmm. Whatever it is. If you sell it enough, aggressively enough, people buy it. Gerber, the baby food company, still sells whole life policies to people when they get a baby so that they can go to college. Well, let me tell you where you're going to college. Nowhere.
Not with that.
You're not getting in anywhere with that policy.
Yeah.
Okay, because you're going to make $14 when it's all over. You're getting screwed. No. Listen, if you buy your financial products from a baby food company, it might be an issue.
You're doing it wrong.
Okay? If your baby food says American Funds on the outside of it, you might have the wrong baby food. Come on.
Don't eat it.
Stay in your lane, people. Stay in your lane.
And you talk about why this is a bad product. It's trying to do two things at once. It's trying to be insurance and an investment. And you're saying, hey, there's way better ways to invest.
And it's always only one, and you're always paying for both.
Yep.
That's the problem.
So we recommend term life insurance, level term life, 15 to 20-year policy to where you're self-insured when that policy runs out. And
that's
it's
for
a fraction
adults.
of the price.
That's for adults.
Yeah.
And
for
if you
the
want
kids,
to save money for your kids, save money for your kids.
But there's no need
in
for
a mutual fund.
A life insurance policy
no,
on
you
your
don't need a
3-year-old.
life insurance policy on a kid. Because if they pass away, you didn't lose their income. Now, if they get a $2 million ad campaign contract with Huggies because they have a cute butt, that's great. Then sign up a life insurance policy because now you have an income there for this cute butt.
Yeah.
And you've got to take care, you got to protect that. But that's 99% of the children do not make an income that's worth insuring. Okay, so this is just, and so it's being used as a savings vehicle for college, and that's a freaking joke. So what happened was her parents paid into it her whole life, 20 years, and she got $5 or $10,000 out of it.
It's the sunk cost fallacy. I got to keep this thing alive because we've been keeping it alive forever.
Yeah, it's the sacred cow. We've always done it this way, and this is why we will always continue to do it this way. We have no other reasoning. That's it.
It's a bad reason.
It's a sacred cow rule. Yeah.